Hello, everybody, and welcome to the third day of SteelMint Engage 4.0 webinar series. We have already covered a gamut of topics. Much deliberations have happened on global and local topics, but a lot more is on the cards, and today's topic will unmistakably be of interest to all stakeholders in the steel industry because it is on the giant China. I'm Madhumita Mukherjee, editor, SteelMint. And with me today is my colleague Indranath Jha, who will co-host this webinar with me. He will be joining me in Kolkata from Raipur. Indra, can you introduce yourself, please?
Yeah, I'm Indranath Jha, Manager Iron Ore and Pellet, and I'm very excited about the today's topic and the lovely guest we have.
Thank you. Thank you, Indra. We have Mr. Arthur Lee, SteelMint's China associate, joining in from Beijing. I also want to thank the Indian Steel Association for extending support to SteelMint Engage 4.0. A reminder to the audience that we will take questions from you all toward the end of the session, so you can share your queries. Now, the topic for discussion today is Chinese steel production cuts, outlook on prices and exports. Three key factors have been playing out in China for quite some time, and these include subdued domestic demand, competitive export offers, and rising crude steel production. Mills squeezed by losses or thin margins have resorted to exports to offset their bottom line. China's finished steel exports have been rising consistently since September last year. Its HRC export offers have also dropped suitably to woo overseas buyers. Chinese steel prices heading south were expected to drop even lower in June. As a source said, it has become increasingly obvious that China's ferrous market fully concurs with the Bani concept. It is brittle, anxious, non-linear, and incomprehensible, with bearish news from various sources spreading at home and abroad. So what is the scenario playing out at present, and what holds for the future? We have two experts joining us from Shanghai, and from whom we will glean more information. My first speaker is Ms. Xiaoying Zhang, who is a ferrous commodity analyst at Baowu Resources. She graduated from Columbia University with a statistics major. Her research is focused on areas of metallurgical coal, iron ore, and steel in China, and also the ex-China market. Requesting Ms. Zhang to take over the screen. Indra can share the screen. Indra, you can share the presentation.
Can you see the presentation?
We can.
Yes.
Yeah.
Great, thank you. Hello, everyone. Good afternoon. This is Xiaoying Zhang from Baowu Resources. It's really a great honor to be invited into this webinar. So recently, one question that frequently was asked is how will China's steel mills reflect to its low profit margins? So today, I will talk about this question. I will first start from what is the profit level right now in China, how it has happened, and what is our outlook under this profit level. Okay, so first page, we have rebar and HRC spot and future profit index. This index is simply calculated by rebar and HRC price minus raw materials cost at that time times the raw materials to steel ratio. Here we can see that rebar and HRC calculated profit this year, the red line, is better than that of the second half year of 2022, the orange line. However, when we look at the second page, the next page, the average gross profit ratio reported on 15 A-share steel companies and CISA on their financial statements dropped a lot since 2018. The main reason is that there are a huge depreciation we need to further consider. As we all know that on late 2015, China launched a supply-side structural reform focused on reducing distortions in the supply side of the economy and upgrading the industrial sector. Therefore, since 2017, because of the higher maintenance costs, more equipment upgrades, and by environmental related investments happen in steel industry. The actual cost of steel miles, besides simply raw materials costs, have risen rapidly, and the net margins of steel companies have shrunk after that. So we need to pay more attention that steel companies have already at one of their lowest profit level. The left chart is the average gross profit ratio of main A-share steel companies. There are more than 15 steel companies, but we took out the outliers here and took the arithmetic average of the quarterly gross sales profit ratio. We can see there is a peak of profit ratio in 2018, and then the ratio came down by years. On the right side, we have the total profit of medium to large size CISA member enterprises. The lines draw on quarters where we can see the profit in Q1 this year almost dropped to the level of 2016. In Q1 2023, we still have an increase in steel prices. Whereas in Q2, well, we expect the total profit may be even lower than Q1. So this is our policy background of low profit margins in steel industry. Okay, next page, please. When we look precisely into the spot profit since 2017, we can see profit decline also appeared in 2022. Here we can see on the bottom left chart. So what is the difference of 2020 low margin and 2023 low margin? I've listed data in the gray box. I listed the percentage change of every commodity during 2020 and the change of the first 5 months this year. By comparing this percentage of change, we can find that 2020 profit decline was a decline aimed by raw material prices surge. For example, here, iron ore surged by 80% and coke increased 33%. Well, this year is a low profit year with even lower raw materials costs, primarily driven by weak end user demand. We can see that iron ore declined 15% on the first 5 months, rebar declined 11%, and coking coal and coke decreased most at 24% separately. Therefore, this year, China's steel mills have to face more serious conditions than 2020 with lowering margins and lowering raw material prices. With the not improved demand, the mills are unlikely to increase their blast furnace operating rate and also the capacity utilization rate. The mills would take less opportunity of better margins. Okay, so on next page, please. Therefore, at this low profit margin, steel mills have to consider more about the price of raw materials to adjust usage ratio in order to further reduce costs. We can see on this page that mills tend to increase usage of hot metal instead of scrap in steel making because scrap is more expensive than hot metal in China in almost 100 yuan right now. 100 yuan, sorry, right now. And for blast furnace raw materials, mills tend to increase usage of cheaper sinter fines in blast furnace compared to lump and pellets. We can see here the hot metal to steel ratio is increasing, and on the right-hand side, the sinter ratio, the blue line, is at the highest position. With lowering margins, we expect that the hot metal usage ratio and sinter usage will be unlikely to drop dramatically. Next page, please. Based on the background I've just went through, we can give an outlook of steel mills under low margins in that, firstly, given the general view that steel end user demand is unlikely to improve over the upcoming months. Therefore, at this low capacity utilization rate, mills' profit margin is hard to expand. As you may heard that there's a plan that requires Tangshan local steel producers to ensure that steel production this year does not exceed the level of 2022, which is 1.018 billion tons. Although a formal policy document hasn't been released yet, if it is true, we estimate that the iron ore demand is likely to drop and the iron ore supply will exceed demand by 30 million tons. Iron ore price will come down, where we may see high-grade ore price will slightly rise, more compared to low-grade ores. Even if there will be no formal policy published, we still think the profit margin will remain low because of the weak demand. While under weak demand market, the market volatility will mainly come from restocking. We can see on this page that the mills hold lesser raw materials inventories than finished products. These are my steel research data. They mainly research 247 main steel companies, although like my steel sample size is not all covered, but we still notice that the low inventory appeared. Iron ore, coking coal, and coke are at their lowest stock, at least in the past 5 years. With low inventory, margins will continue to be squeezed as raw materials prices will surge more than finished products prices, meaning that raw materials will be more price elastic. So this is also had to the result of low steel profit margin at the end. Thank you. That's all my presentation. Thank you.
Thank you so much, Jang, for your wonderful presentation, very concise and in a brief manner. Now I would like to request Madhumita ma'am to take the session forward.
Okay, thank you, Ms. Zhang, for that very in-depth presentation. We now have Ms. Yao, who is experienced in macro research, trend identification and forecasting using both fundamental analysis and quantitative models. Before joining Horizon Insights, she worked for the World Bank and International Monetary Fund in the United States for 4 years. Over to you, Ms. Yao.
Yeah, sorry, I can't share screen. Is it possible that you could share the, can you hand over the right for me? It says that only the host can share.
Yes, Indranath, I think you need to share the screen.
We need to share
the
screen?
Yes.
I can't, so you're gonna have to do it for me. Thanks.
No problem. We'll do it.
Just give me a second. Are you able to see my screen?
Yes.
Yeah.
Can you put it on display? Like hit the right corner. Oh, I'm sorry. The on display button. Because this is small, you know. Yeah.
Is it fine?
Awesome. Yeah. Please go to the first page. Thanks. Right. So hello, everyone. I am a macro analyst, but I will touch upon both the macroeconomic conditions in China as well as our views on the ferrous market in general. So there's a lot in my presentation, but I'll try to be precise and concise and just to convey the key messages here. But happy to discuss if you have any questions later on in the Q&A session. So first off, if we want to discuss the economic condition in China, we have to start off with the GDP target. So the target is typically sent out every year in March during the 2 sessions, and this year is 5%. So how do we understand that 5%? It is a stable growth target, meaning that there's the government is not craving for a expansionary scenario this year. And if we do a breakdown of GDP, you can see that the most important contributors are consumption as well as fixed capital investment. And this year, if you look to your left-hand side in the chart, we can see that because of all the restrictions on like COVID lockdowns, stuff like that, China just saw a reopen last year in December. So this year, there's a natural tendency that consumption will come back to the pre-COVID level. And that will give us about near 10% of consumption growth this year, year on year. So only that, if you take into consideration, China's service GDP takes up about 38% of GDP contribution. So that would give you naturally over 3% of GDP growth just from the consumption sector, meaning that for the government, there's not much pressure coming from the rest, which is the three pillars we typically talk about. That is to your right-hand side, manufacturing, infrastructure, and property. So there's not much pressure. However, if you consider the fact that property sector this year is going to be shrinking, as well as the net export is going to be shrinking as well. So if you just let it be, then the decline in property as well as export will become a drag onto the economy as well. So still this year, the policy will have to do some adjustment in order to make up for that. Next page, please. So let's take a look at the three pillars individually. First, on infrastructure, people care about how much the strength is in infrastructure investment. And to your right-hand side, people care about the red line, which is the growth, year-on-year growth of the infrastructure investment into the transportation sector. This sector serves more as a driver on the consumption of steel in general as compared to the other sectors. So people care more about how much money is actually flowing into the sector specifically. And you've noticed that the growth rate has dropped somehow. But if you look to your left-hand side, here we're tracking the progress of the issuance of special purpose loan. This is basically how much money is directed into the infrastructure sector. And you can see that it's on track. We think it'll track the black line, which is the same as last year. So what's driving the fluctuations is really how much funding is given into the specific sectors. So that means that the overall investment is high. It's just the fluctuations is created basically through how much money is devoted into different types of projects. Next page, please. And then let's talk about manufacturing sector. This year, manufacturing PMI has been fluctuating in China. We're not seeing a sustained kind of growth in manufacturing PMI. And on your right-hand side, you can see that for the industrial enterprises, they are still, whether actively or driving by the weak demand, they are destocking and they are not restocking yet. For that to happen, you typically have to see two things. First, you have to see an increase in liquidity in funding overall. And second, you're going to have to see that demand improve. And neither of that has been true right now. Next page, please. So in a sense, as we haven't seen that the terminal demand rebound and the fact that supply has been a focus of the market, we're going to touch into that later on. So you can see on your left-hand side, the blue line indicates that the industrial enterprises margin has been pressed down. And if you look to your right-hand side, that is reflected on the futures market. You see that prices of rebar has been declining, and that is a market squeezing out the production margin, just like the first speaker just said. So they want to squeeze out that margin in order to see supply decrease so that supply and weak demand can be balanced again. So this is what's happening in the past in the Chinese market. And next page, please. So now we've talked about infrastructure and we've talked about manufacturing, and what about property? So this year, as you can see to your right-hand side, the sales has been, well, it's not bad, but it's definitely not as people expected. It's not rebounding greatly. And to your left-hand side, the only highlight seems like the growth in completion. And on new starts, the developers are very cautious. Next page, please. And are we seeing some changes already? And yes, you've seen that yesterday there's been a rate cut, and such rate cut will be materialized. We think we're going to very soon see a cut in MLF, which is a policy rate, as well as LPR, which is a guidance rate for the commercial banks in China. And also, we've already seen some policies targeting the property market specifically. To your left-hand side, this is Qingdao. This is one of the cities in China. And on June 1st, the restrictions on purchase of the second house in Qingdao has been lifted. So you've already seen that such policy is effective, and we've seen a rebound of sales in Qingdao. And the question becomes whether we're going to see similar policies applied to other cities. On your right-hand side here, I listed out a list of cities with purchase restrictions and their contribution to the overall sales And you can see that could be a potential way to boost the market. And we're going to have to wait and see if this is the way, the government wanted to go. But if they do go this way, then it's going to serve as a stimulus to the property market. Next page, please. Now, for this year, we think policy could be it could be flexible, and it could come out anytime the government think it's necessary. For one major reason is that this year, even though we're not craving for expansionary year, still we're doing some structural adjustment. What type of structural adjustment? To your left-hand side, you see that for the property sector, the inventory as well as inventory turnover is very high. And to your right-hand side, you see there are some structural problems, meaning that in the past over years, developers focused on new starts. They've started a lot of investment, however, they're not delivering. So you'll see that construction is high, but installation work is low. So for this year, it's going to be a big year for installation, but a low year for new starts and, for investments. And next page, please. So given that fact, this year, we're going to just expect more policies to come out to adjust to the market changes very flexibly. But what type of policies are expected? We can answer these questions in the later Q&A, but here I'm just going to mention a few. First is, since we've already seen the price cut, the natural question becomes, is this a one-time rate cut, or that we're going to expect more rounds of rate cuts in the future? And we don't know yet, but we are more tended towards the first scenario, because we think rate cuts isn't the right way to target, this year's problem. We've mentioned there are some structural problems, and such problems needs to be targeted separately. And there's another problem. We think that the leverage ratio in household sector as well as developers and banks are really high this year. So we probably have to see a transfer of, these banks and household sectors leverage in order to see them to be able to purchase, to invest again. So I'm not going to describe the specific ways here just yet, but to your left-hand side, you can see that the lowered mortgage rate, we've reversed the red line, so it's declining, is not really pulling up the sales. So we don't think rate cut is the right way to go. It's going to be similar to Japan. Even though you cut the rates to near zero or even to the negative zone, consumption is not responding. And next page, please. And you can skip this one. And so to your right-hand side here, I'm showing you, because yesterday the total social financing number came out, and people see that it's still very weak. It's not meeting the market's expectation. So for a lot of traders in China or in America, basically in the overseas market, they are depending on the liquidity cycle in China to bet on, whether China's economy is going to follow upon. So to your right-hand side here, I'm displaying the Golden Dragon index, which is listed on NASDAQ. So you can see that it basically tracks the liquidity cycle in China. So it's very important that total social financing started to grow again, and that would drive up the market sentiment altogether. And next page, please. And next, you can skip this one. And this one as well. Right, so now let's dive into the ferrous metal market. So what I've described to you just now is we've went through the 3 pillars. For infrastructure, we think it's going to remain high growth rates. For manufacturing, we think the problem is that for the industrial companies, they are not restocking, and they are basically waiting for more stimuluses or an improvement in the terminal demand, so that they can see basically a broaden of their profit, but that hasn't happened yet. And for the property market, it's weakening, and we've just saw some policies coming out. We're going to have to wait and see their effectiveness, but we think policy is going to react relatively sooner this year compared to the past years, just to complete that structural changes and to maintain the economy's capability to achieve that 5% GDP growth. So how does that affect the ferrous market? So first off, to your left-hand side, here's what's happening to rebar price. You can see the blue line is the rebar price, and it's been declining ever since March. And while it's declining, we've also seen that the production cost is declining as well. And it's basically tracking the off-peak electricity measured production cost, which is the lower bound of the blast furnaces production cost. So right now we've seen a rebound. So we think the reason behind it is that, a lot of the raw materials prices has dropped as well. And rebar actually has continued to destock. If you could go to the next slide. You can see here as rebar prices decreases, which is the market craving for a cut in supply, as we just described in the beginning, so that the supply level can meet the weak demand level. And we've already seen such effect, right? So on your left-hand side, the blast furnaces has decreased their productions, but more decrease has been seen on the electric furnaces side. So given this level of cut, what's the effect on the inventory? Let's go to the next slide. On the inventory, we've given you two scenarios. The first scenario is more possible and it's positive. This one, to your left-hand side, we give a forecasted demand. So the demand basically tracks the 2022 trend, meaning that we're going to see about the same level of sales coming from infrastructure, coming from property, and the demand is going to fluctuate. There's going to be not going to be huge ups and downs. So given such demand and given the current production level, we think that the decrease in rebar inventory is going to be something that the market trade on later on. The market will think that currently the production level is actually lower. So that could be a short-term driver for the rebar price. So this is a more possible and positive scenario. And on the next slide, we give you another scenario, which is something that the market fears. Can you go to the next slide, please? And on this one, our assumption to demand is that it's going to be similar to 2021. Such year because of a set of restrictions onto the developers are being executed, so that demand is actually decreasing. So on such a scenario, you can see that given the current level of production, we're not going to see further cuts into the rebar inventory, and rebar will continue to experience another round of price decrease. We think that the previous positive scenario is more possible. And the reason is that if you can go to the next slide. Currently, the scrap inventory is also very low. That's because that basically tracks the demand. It tracks the prices. As price increase, typically we're going to see scrap price increase as well with rebar. And now since the demand, the inventory of rebar has been decreasing, and we think over the weekend, people started to talk about the leveling control of production possibly coming out in the second half of the year. We think production itself will become something that the market worry less about. Then the worry will be coming on the inventory side. So going forward, if people were to trade on the fact that current cut in production itself is enough, and possibly we're going to have to see an increase in production level, then that increase may be on the scrap side. And the reason being on your right hand side, as the price difference between scrap and rebar enlarges, and also a lot of the cut is on the electric furnaces side, and also on the, if you can go to the next slide, I'm not sure if I have that figure here. Yeah. To your left-hand side, here's the production cost. If you look, just compare with 2019 and 2021, 2019 and 2020, the years like this, you can see that current production cost of electric furnaces is actually higher. So if people were to trade on the fact that there's going to be limited room for hot metal output, to your right hand side, you can see it's already very high. Given the current price difference as well, scrap is cheaper compared to the hot metals. So it could be that the market will track the electric furnaces production cost for a higher bound of price. So to sum up, we think overall the economy in the second half of the year still on demand side, there's not going to be a lot of highlight because the government is still dealing with the structural problems. But it also means that in the very short term, with demand, just fluctuating and the policies coming out, potentially serving as a support or even a stimulus to that. In the short term, we think the trading focus is going to be on the demand side instead of on the supply side. So current supply level may be already lower. And if people were to trade on the increase in supply, that could serve as a upside for rebar. And for the higher, upper boundary of the price, we think in the future may track the electric furnace production cost. I think that's it from my side. Thanks a lot.
Thank you so much.
There's another 2 slides, but we can skip them. Yeah.
Not an issue. Thank you so much, Junyo, for your detail and articulated each and every point very briefly. Thank you so much for that. Before going forward, we have a certain set of questions to ask to both the panelists. So I'm handing over to Madhumita ma'am to ask to begin with the questions answer session.
Yeah, the first question is Ms. John can answer and Ms. Yao can also add. What is the outlook on Chinese steel prices for the rest of 2023?
Yes, I think Ms. Yao has already talked a lot about it, but we think it will remain range bound. We think the total demand will decline in 2023 and will be difficult to see a substantial improvement in global steel demand too. That is on the one hand, under low inventory, prices will be supported by costs. However, prices will also be suppressed by downward demand. So in the second half year of 2023, we think steel prices may remain range bound. Yeah.
May remain?
Yeah.
And I didn't get your last word. May remain?
Range bound.
Okay, thank you so much.
Yeah.
How are Chinese mills managing steel margins? I mean, we all know about the squeezed scenario. So do you say imports of low-grade iron ore will gain more pace versus pellets or high-grade iron ore?
Yeah, since the Q3 2022, Chinese mills have maintained the low steel margins, as we all know. In order to reduce costs, mills have made great adjustments to the ratio of raw materials, such as reducing scrap, reducing pellets, and lump ratio, as what I've just talked about. So for the rest of 2023, we think the margins of mills will hardly improve. Therefore, without any impact of other external factors, we don't expect mills will make much adjustment to the ratio.
Thank you.
Yeah.
Isra, you want to ask anything now?
Yeah, actually, I would like to ask question to Yao that what is exactly the status of decarbonization plans of steel mills in China?
I'm sorry, what's the plan of what?
Decarbonization plans, as you know, the whole across the country is asking about this green steel and the decarbonization. So my question is, what is the status of decarbonization plans of steel mills in China?
Decarbonization, I'm not sure if that's something Ms. Zhang targeted or not. For us, it's something on the agenda, but it's not something that's been pushed out very aggressively just yet. So for this year, there are some effects. For instance, I just talked about the leveling production control, which is we're going to maintain the same year-on-year production level as last year. So this is some of the reasons come from environmental, concerns. So because sometimes we see some steel mills are, so the production come down is actually because of air pollution. So that's something that in the government actually targeted. But if you talk about the overall, if there's any like revolutionary changes to the steel mills production, we don't see much just yet. And I don't think that's the target for this year.
Okay.
Yeah, if you want to ask some steel mills plans, I can say that in order, like everyone knows, the presidency had announced 30-60 decarbonization goals, like the meaning that China is committed to hit peak emissions by 2030 and carbon neutrality by 2060. So following that national strategy in 2021, Baowu rolled out a roadmap to hit peak emissions by 2023, reduce carbon emissions per metric ton of crude steel by 30% by 2035, and achieve carbon neutrality by 2050. And actually on Monday, Baowu has signed an MOU with Rio Tinto to develop projects aimed at enabling lower grade iron ore to be used in low carbon steelmaking. So we're keep doing on that. And also Baowu has a series of hydrogen rich blast furnace technology and pure hydrogen furnace technology projects in Xinjiang and Zhenjiang unit, which has already achieved a lot. So yeah, thank you.
Thanks a lot. I think Ms. Yao mentioned that PFs are now more prone to using hot metal than scrap because the latter is more expensive. So this question is to both of you. So do you see Chinese mills increasing scrap usage in the near term? Will it result in increasing scrap imports?
Maybe I can target that first. Our observation is that given the current level of production margin of the steel mills, if you compare to the historical levels, typically their need for hot metal is about, I think, 2.6 million tons or something like that. So that gives us very limited upside in the potential, increase in hot metal. So also taking into consideration that the price difference between scrap and rebar has been enlarged. And in the past, when that trend continues, typically need for scrap is going to increase as well. So we don't know whether on the industry level that's going to happen yet. We just think that people may start to trade on that. And that has to meet one premise, which is that demand itself cannot decrease. So we're assuming that if demand maintains 2.95 to 3.05 million ton per week, then given the current level of production and limited upside in the increase of demand for hot metal, that would crave for an increase in demand for scrap. So if in that case, currently the production cost for the electric furnace is about 3,850 something yuan. So that could be a potential, upper bound for rebar prices.
Thank you so much.
My question is to Jiang that do you see that the imports of low-grade iron ore to gain pace versus those of pellets and high-grade ore?
Sorry, I think that is a pop-up question, right? So can Ms. Yao please answer that?
I can talk about iron ore price overall, but I'm not an iron ore analyst, so I don't know about the grades, but definitely happy to revert to on that question. We have iron ore analysts here in our firm. So yeah, so for iron ore, as I just mentioned, we think there's limited upside for hot metal supply increase. So meaning that the upside for iron ore price is very limited. I have to say, like in the second half of the year, we still think iron ore may outperform rebar because rebar tracks more the demand, whereas the changes in rebar supply serve as a kind of a safe cushion to iron ore. So, but in the short term, we think currently considering the limited increase in demand for hot metal, as well as the possible execution of leveling control of overall steel mill production, that means that currently we think the upper bound for iron ore price is in the range of 830 to 850. We don't give it too much upside just yet, And if, let's say, the execution of leveling control on production is executed this year, we think if iron ore price were to decrease, the lower bound is somewhere about $90 US. And that is, we're given it basically 95% of its production cost, and we're giving it another $5 upside just to make sure that they don't, they're still making profit. So that's that.
Okay.
Yeah.
Two very important and quick questions. What is the projected steel production from China by 2030, and how much would it be from hot metal, and how much would come from the EF route? Will Ms. Yao take this? Take this question?
I don't have an answer for that right now.
And what will be the iron ore demand by 2030, and how much will it be fulfilled by imports? Anyone? Would you like to take this question as well?
I'm not sure if Ms. Chen has an answer for that. So for these type of questions, I will have to ask our analysts. Yeah, but we have answers for them, just I don't have it right now by hand. Yeah.
Great. We would get those answers from you later, definitely.
Yeah, for sure.
And Ms. Yao mentioned about some policy support to the weakening property sector. And if I could ask Ms. Zhong, how is the end user demand in China, panning out, especially from construction and infrastructure? When is there a possibility of an upturn? Would you like to comment on this?
What is the? Yeah, sorry.
Sorry, could you please repeat the question again? I didn't.
Sure. Ms. Yao did touch upon this, so I wanted some perspective from you as well. What is basically, how is end user demand panning out in China, especially from construction and infrastructure, it being the largest contributor to steel demand? So
yeah, sure, I can answer that from my side. So we think that the China's steel demand has shown strong resilience this year. So on the one hand, the deceleration of real estate is very obvious, dragging down the consumption of steel, long products especially. However, since last year, the proportion of structural steel in total China's steel consumption has been already declining for a while. On the other hand, we think that China's manufacturing industry is picking up, and investment in China's new energy industry is accelerating. So bringing new growth points for steel consumption and stabilizing the China steel consumption. And also the really important thing is that we can see that steel inventories as a whole have continued to drop, representing relatively good demand condition. And also the high exports was also cited as partial explanation, as we all noticed that steel exports increased 40% year-on-year in first 4 months, while exports volumes are small versus the domestic steel consumption, but they did account for like half of the reported growth in steel production in Q1.
But I'm going to come back to your exports. I would like to ask Mr. Yao if you would like to add anything to the demand and consumption aspects for the rest of H2 for the rest of the year.
Yeah, I think I've covered some in my presentation.
You have, yes.
Yeah, but I'm just going to talk about just a few, like, for instance, in terms of infrastructure, if people paid attention to my slide, you will notice that I only talked about a special purpose loan, and that is only one source of funding to infrastructure. And another source, which could be important, is through the so-called financial bond. This type of bond are issued by the policy banks in China, and they basically, their leverage ratio is very high. So for $1 that they spend, they're gonna leverage another $4 in the market. So that's private credit. So that could be a huge stimulus to the infrastructure industry itself. So are we expecting that this year? Not yet. But if we were to expect such financial bonds coming out, it's going to be the second half of the year. It depends on how the property market is doing. If it's doing very bad, then possibly we're going to see something like this. So this is kind of the policy stimulus I didn't talk about. So just to discuss a few scenarios, if like demand is really bad, then policy may come out to serve as just a support.
Okay, thanks a lot. Now, will Chinese steel exports continue to remain on the higher side in over July to December 2023? And what are the factors that will drive this trend? Ms. Zhang, would you like to take this first?
Yes, sure. Well, this is really depends on the ex-China steel production. If ex-China market could increase their steel production in the upcoming months, we will have less demand on and they will have less demand on China steel. However, if ex-China will remain low steel supply and Ukraine and Russia still cannot recover to the market, then China may increase exports to fill the global demand gap. Well, in addition to the ex-China recovery condition that may affect the steel exports, the other factor we also need to consider is that China has cost advantage of ore blending compared to the other countries. So based on that, we do think that China's export may decrease from the first quarter, but may remain at a relatively high value.
First quarter 2024.
No, decrease from the first quarter of 2023 this year.
Okay. Indranath, would you like to ask anything more?
Yeah, we can take quickly questions from our Steel Mint attendee that we have certain set of questions. So one of the attendees wanted to know, is there any possibility of further coke price cut? Mr. Yao, is there any possibility of further coke price cuts? Is there any possibility of further coke price cuts?
Coke price cuts?
Yeah, coke price.
Yeah. I'm sorry, Ms. Zhang, do you want to take it first? I can add up.
Sure, I can answer a little bit on my side. I think the coke price this year is just follow the rebar price. So if the rebar price is declining, then the coke price will decline too. And also we can see that the supply of coal is really pretty good this year. So we from the coking coal side, we also think that the coking coal will decline too. So there is no reason that the coke price will remain at a high level.
Yeah, so maybe I can add to that. So overall, our view is about the same. We are pretty negative on the coal price. There's a lot of reasons, right? So at the beginning of the year, everybody knows, but the sheer supply is going to be very strong. There's going to be import from Mongolia increasing as well as from Australia. Although we don't see yet import from Australia, it started to increase just yet because they're still more expensive. But the current supply demand condition in China is already bad. So we've already talked about, so we talked to a lot of mining companies as well. So in China, the valuation of coke is basically based on their long-term contract. So for that long-term contract this year, the price is about 570 to 770, and this is in Chinese yuan. So the average price is basically 670. So that is a lower bound, for coal overall, but we don't think it's going to drop to that just yet. So we think right now it's going to be about 300. We're going to view that as a lower bound. And the other thing is so I think is it yesterday or just recent days, we've seen some notices coming out saying that the government is basically still overseeing the coal prices and saying that they're gonna basically supervise if there's any speculation in coal prices. So there's still some policy risks over there, as well as with iron ore as well. So just remain cautious for such policies. Yeah.
Thank you. We have another attendee question. Can you highlight the volume on steel scrap generation in China, and will the conversion spread enlarge further for the rest of 2023?
Yeah, in terms of the volumes on scrap generation, this is something I have to come back to you again. Like I said, I'm not the commodities analyst, I'm a macro analyst, so I don't know the numbers by heart, but I can get back to you definitely after this. So about the spread, will it in large? I'm not sure if we're talking about the price spread between scrap and rebar. That is happening right now. And if there's not going to be actual increase in the steel mills production, then such enlargement will continue. But if there's going to be an increase in production driven up basically by demand being still it's not dropping basically, as long as it remains about 2.95 to 3.05 or even higher. It could what could potentially happen is that production of steel mills may increase. In that case, the spread will not enlarge, it will shrink.
Thank you so much. We're getting a lot of questions on iron ore and pellet prices. So would you take this question? What is the outlook on Chinese iron ore and pellet prices? Would Ms. Yao take this question?
On iron ore prices, I think I talked a little bit, like the range that we give on futures price is right now, we are seeing the upper bound as somewhere in $830 to $850 US. And the lower bound, that is kind of like a negative scenario, meaning that there's no production increase in steel mills and demand kind of decrease. Then the lower bound we give is $90 US. Yeah.
Thanks a lot. I think that's about it. And we have to.
I'm sorry, I think for the upper limit, I talked about Chinese yuan 830 to 850. And for the lower bound, I talked about $90 US, and that translates to 710 Chinese yuan. Sorry, just need to correct that.
Thanks a lot. We have to bring the curtains down on this session. It was indeed a very engaging one, and we hope our viewers felt the same way. A very warm thank you to Ms. Zhong and Ms. Yao for giving us your valuable time. Thank you to my colleagues Arthur Lee for joining in from Beijing, and to Indranath Jha from Raipur for co-hosting this session with me. A big thank you again to the Indian Steel Association for its support. I'm Madhumita Mukherjee, editor Steel Mint, saying bye till the next time. Bye.
Thank you.
Thank you.
Everyone.
Okay, thank you.
Bye.
Bye.
Thank you. Bye.